Okay, and today we're diving into one of the most interesting aspects of Canadian real estate, and that is amortization periods. Yes, I know it sounds boring. Who cares about amortization periods? Well, it's got everything. It's got chaos, it's got explosions in interest rates, it's got balloon payments, government interventions, and more. And with our neighbors down to the south considering or flirting with the idea of 50-year amortization, it begs the question, what's in store for us? And could something like that happen here? Well, let's hop in the time machine, go back and see how did we get to where we are and where's this leading us? The early 1900s was known as the hope you have cash era. Mortgages back then were essentially just a handshake and a prayer. Amortization terms, if you want to call it that, were between 1 to 5 years, interest-only payments, and a giant balloon payment at the end. There was no real amortization, no predictability, and it was mostly predicated on vibes. To give you some perspective, it could essentially go like this. You could get a call from your bank manager and they would say something like, hey, you know that loan you got from us? Well, it's time to pay it all back tomorrow. And to give you some context for the conditions that people were purchasing homes in back then, a down payment was typically between 40 and 60%. It could be more. Most Canadians either built their own homes or inherited them. The people that were buying real estate had large amounts of savings, already had land or inherited it, or had a very strong support system within their family. Kind of like some of the stuff you need to do it today. And back then, borrowing money was more of a relationship thing than it was a standardized system like we have today. Then we jump ahead a few years to the 1930s, and I think you know where this is going. Fighting out of the blue corner, we have the Great Depression. And in the red corner, we have the introduction of real amortization. No, but all joking aside, the Great Depression hit, and all of a sudden, those giant balloon payments that people were making all of a sudden worked for, well, nobody. Banks didn't want to get hundreds of houses back, homeowners couldn't afford to refinance their homes, and the whole thing looked like a complete unmitigated disaster. But from that disaster was born the idea of the first longer amortization periods, and that was starting with 15 to 20-year amortizations. Payments became predictable for the first time, and governments actually began encouraging safer lending practices. It was also at this time that banks clued into something that was absolutely revolutionary at the time. And they thought, if we let people pay us back slowly, they will actually pay. I know, crazy idea, right? And from there, we jump to 1946, and this is when the CMHC was created. The CMHC is the Canadian Mortgage and Housing Corporation. Soldiers were coming back from World War II and ready to start families and start buying their homes. And at the same time, a baby boom was starting. But Canada had a problem. There was a housing shortage. This, as I'm sure you know, will be a common theme as we go further along in this video. With the creation of the CMHC, the government was essentially saying, hey, we're going to make mortgages predictable, stable, and not terrifying. With the creation of the CMHC, they standardized mortgage lending practices, created the 25-year amortization period as a benchmark, and with access to mortgage insurance, actually broadened the idea of home ownership for a lot of people. Young families wanted stability, smaller payments, and a real path forward to home ownership. And the CMHC was there in embryo, helped them provide a path to that. With the creation and popularization of the 25-year amortization period, things hummed along quite nicely for the next couple of decades. Things were stable, reliable, and predictable. The economy experienced growth, home prices were relatively low, lending practices were predictable. But, and you knew there had to be a but, the high inflation of the 70s was lurking around the corner, just like the Grinch, ready to steal the roast beast. And when the 1970s hit, interest rates went up like they were going for the gold medal at the Olympics in the high jump. And with those high interest rates came struggles. And that takes us into the 80s. Yes, big hair, big music, and even bigger interest rates. Yes, people were taking mortgages at 18 to 21%. I'm sure you've heard people tell you about it. And in response to this, lenders extended the amortization period, and this is when we started seeing 35-year amortization periods. The extended period became essentially a survival tool, and it's not like they weren't trying other things. This is when they were experimenting with different kinds of variable rates, blended rates, convertible rates. The list of tools that they tried to combat this goes on and on. With those adaptations and changes, the banks came to realize something, and that realization was the longer the amortization period, the lower the payments, the more home people will actually buy. All of a sudden, longer amortization periods were all the rage, and the banks were in. We're talking 30-year, 35, 40-year amortization periods. People at the time were able to actually get mortgages with zero down. But with the increased ability to buy and the increased ability to buy more, that also means other things are going to happen. And that means more competition. All of a sudden, much larger portions of the market were actually able to go out and buy homes. And I bet this sounds pretty familiar to you, almost like maybe it happened, 4 or 5 years ago. And with increased competition, I bet you know what that means. That means prices start to push up. Now, it's not quite in leaps and bounds like we've seen here in the last decade, but it was that idea just in the early stages of it. Lending practices were also becoming a lot more competitive. And because the cost to purchase these homes was lower, quote unquote, because of larger amortization periods, people felt like they could buy more because their monthly payments are going to be a lot more reasonable, especially when compared to the decade previous. And for a time, things were humming along quite nicely for everybody. People were fine with the longer amortization because it meant more reasonable payments and they could buy more house or get into the areas they wanted to get into. And then we hit 2008. Global financial crisis, the house of cards collapses. It would be like if you caught your kids having a house party and, shut that music off, everybody get out of the pool. Ottawa steps in and removes 40-year amortization, 35-year amortization, and sets the insured maximum to 25 years. And on top of that, they instill new practices for refinancing as well as proving your income, thus making it harder for people to now get these mortgages. With that, we end up where we are today and more or less how it's been for just over the last decade. If you have less than 20% down, you're going to get a 25-year amortization max, but an insured mortgage. And if you have more than 20% down, you can go up to 30 uninsured. And during this time, financial institutions have been more concerned with household debt concerns, creating stability. They did introduce the stress test as a way to combat this, so to stop people from overextending. And for the most part, lenders generally try to keep things pretty tight. And it's in this era that financial institutions have been concerned with stability. And this is brought on by things like household debt concern. Many lenders are trying to keep things pretty tight, and you can see other adaptations as a response to this, such as the introduction of the stress test. And now that brings us back to the original question about 50-year amortization periods. So our neighbors to the south are talking about it. Will we see something like that here? I don't think it's very likely. Historically, Canada has been more conservative in its lending practices than our neighbors to the south. And the other question is, well, should something like that happen here? And, I think the answer is a resounding no, it should not. As we've seen through this brief history that I've been talking about here, is longer amortization does lead to some other unintended consequences. Yes, your monthly payment is lower, and ultimately if you take the entire term to pay it off, you will pay quite a bit more in interest. Now, there are all kinds of things you can do, like take that money you saved and dump that into your mortgage every month as a way to shorten down the amount of time it takes you to pay it back. But what it also does is it does open up the market to more people, which will then create more competition, and you will see another cycle, like I've gone over in this video already, probably happen again. So, in closing, no, it shouldn't happen. I don't think it's good, and it's not good either for the economic health of the country. So yeah, I'd love to hear your thoughts about this video. I hope you found it interesting, and as always, let me know what you thought about it in the comments down below, and I'll see you in the next one.